Uh, so, social investing communities, the subject of my keynote today is social investing communities reduce risk and increase upside for startups. What am I? I'm a visionary analyst with 41 years of experience in the financial markets. And what's a visionary financial analyst? Well, it's completely different than a regular financial analyst, because what I do is I research the past to predict the future. So for example, in 2001, I came out, when Enron went bankrupt, everybody remember that in 2001? Enron went bankrupt. I went in and did an autopsy on Enron to see what could have caused this bankruptcy, because the company was a high flyer. It was the equivalent of the Tesla of that day. And I was so shocked that this company could have 27 Wall Street buy recommendations on it in the summer of 2001 and be bankrupt by December of 2001. It just fell from $55 straight into bankruptcy. So I went in and did an autopsy on it, and after doing all my work on it and researching it, I was able to figure out what caused this, what you could have looked at, analyzed to know that it was going out of business. And then I took that and I created an algorithm out of it, and then I used that algorithm to predict the collapse of Lehman Brothers, Merrill Lynch, and Bear Stearns in my September 2007 magazine article here. And we all know what happened to those. But here's what I said. I said, I believe that there will be a day of reckoning. It will be sooner rather than later, and that day will be ugly for the 5 largest brokers. And sure enough, that's what happened. Here's another example of a recent crash that I predicted, which is the most recent October crash. I went in and did a serious analysis in 2016 on the crash of 2008 and the crash of the dot-com bubble bursting in 2001, and I was able to develop an algorithm that predicted the Brexit crash in 2016, and then this algorithm predicted the October crash to the day. You can see perfect storm brewing for possible market crash next week. That was on Friday, the 5th of October. And the market entered into a crash on Wednesday, October the 10th, the very next week. So that's another one of my algorithms that I developed, that I researched the past to predict the future. The next one here is Almost Family. Let me tell you about this one. This was a startup that I underwrote as an investment banker on Wall Street. And when I underwrote it, the reason why I underwrote it, I had done some research on KinderCare, which was the first publicly traded child daycare center. And in the 60s, after the war, post-war in the 60s, child daycare, when women started working, became all of a sudden a booming industry. And KinderCare was the leader of that industry. And KinderCare shares went up 20 times in value in 10 years. So I'd done all this research on KinderCare. So one day a guy comes into my office and he says, listen, I've got an idea for you. He said, I've got an adult daycare opportunity. And I said to him, oh, well, tell me all about it. And it basically was the exact opposite of child daycare, except you're taking care of 70-year-old people instead of children. And I said, why not? That makes all the sense in the world. So I funded it as a startup, underwrote its IPO, and it was just bought out last year by LHC Group, another public company. It's been public all these years and went to $800 million in sales. So another example, this is what I do. I do research on the past to predict the future. Now, let's talk about something that I've done a lot of research on that I'm going to predict what's going to happen in startup funding and startups and the whole startups, all the startups, okay? And that is, the social investing era began in the 1840s due to necessity being the mother of invention. Before the mid-1800s, there was no such thing as investing. People had all their money in the bank, and there was no investors. The word invest came from vested interest, because what happened, the banks refused to finance the railroads. And the community leaders said, okay, we're going to go to the merchants to finance those railroad. So they had to go to the people who were the upstanding leaders in the community that everybody trusted. And that's what happened. That's the story of Lehman Brothers, is that Henry Lehman immigrated from Montgomery, Alabama to, from Austria to Montgomery, Alabama in 1844 to start a cotton exchange. And he was doing business with all the cotton farmers in Mississippi and Alabama. He was the one that went out and got all when the banks wouldn't finance the railroad, he went to the citizens and the farmers and said, listen, we've got to get a spur from Montgomery to Birmingham so we can get the cotton to Atlanta. So the Lehman Brothers Investment Bank was established 6 years later, but Henry was just somebody helping out a community. Now, railroads pioneer investors transformed the world economy back in the late 1800s from agricultural to industrial. If you look at this here, what does this look like that we've seen? That's the internet, okay? In other words, the transformation of agricultural to industrial was the equivalent of what happened with the internet in our lifetime. Before the railroad, all commerce was on rivers, lakes, and that's where rivers, lakes, and coasts, the coast of the United States. And then what happened after that? Now all of a sudden, goods and people could be moved and transported safely across land, and that started the whole industrial economy. So clients of Lehman and the other investment banks, with their RR roots, with their railroad roots, went on to fund inventions and companies which produced dynasty wealth from 1885 to 1976. And you can see all the wealth that was generated from 1885 to 76 here. We're talking telephone, we're talking electricity, automobile, airplane, microchip, personal computer. Easily it's probably more than $1 trillion of dynasty wealth was developed from all that, from what happened because of the railroad. Now, as popularity of investing soared, speculation and fraud became rampant, and we had the Roaring '20s came along, and in 1929 the stock market crashed and Great Depression. Stock market crashed and we had the Great Depression. Now, what happens next is 1933, the social investing era ends when the SEC is formed. First rule implemented by the SEC was businesses were banned from raising capital from the crowd or from the public. Prior to this period, you could go into a restaurant and the bartender could offer you shares in the bar. Prior to this period, before the SEC banned this. So that ban stayed in place until 2016. And you can see here, that's when the new social investing era began, 83 years older, when the Jobs Act lifted the ban. Lifted the 1933 ban, the Jobs Act. So the SEC, with that, now what happened, that's great that the SEC did that, but they did a caveat. And they said, you know what, we'll let companies, startups raise money on crowdfunding portals, but we don't want them doing any curation, recommendations, or anything to basically give one company an advantage over another. So, basically they censored the portals. What basically is what they did is they neutered the portals to keep fraud down. So because of that, the liability because of that, the portals to recommend listings made it very difficult for the public to learn how to invest. Very inexperienced at investing, and they need leadership. You know, they potentially, there's hundreds of thousands of companies and inventions to sort through. I mean, how is somebody going to go to a website, and find, how's a millennial going to go to a website and look through 200 startups to find the one that they think they should put $100 in or $500 or whatever in? So that made it very, very difficult. Now, this is a good example. These regulations, here's an article in May 2018, regulations prevent crowdfunding from meeting forecasts. Okay, that's exactly what happened. Now, in my article back in 2014, I predicted that this was going to happen. Crowdfunding must get back to its roots. I predicted that because of what had happened in Australia, which was the first crowdfunding platform in the world back in, I don't know, it was back 15 years or so ago, based upon what the CEO of the first crowdfunding platform in Australia had written, I deduced that there was going to be problems with the regulations, and that's what I predicted. So back then, I started a social investing community, Dynasty Wealth, the first one, and so here are the solution for the entire crowdfunding and for the entire startups industry in the United States and the world is the social investing communities. Okay, they're the solution. I call them SICs. They're actually an extension of social media. So what's going to happen is we're going to have in the future, you're going to see influencers that are going to have millions of followers. They're going to put $100 into crowdfunding into startups, and it's going to be via these government crowdfunding platforms, when most of the developed countries in the world have crowdfunding platforms. Now, why are the SICs the solution? Because they have experienced leaders who can curate and recommend startups. So the startups community needs leaders that are going to come out of experience and tell them what to do. The investors. The one thing that's deficient at this conference is there's not many investors at this conference. There should have this conference should have 20,000 people at this conference with some of the companies I've seen at this conference today. These companies, every company here should be having a crowdfunding offering available to raise $100 from all those investors, because they can legally do it for the first time since 1933. So they also need the social investing communities are needed to educate the members on how to invest in startups and build a startup portfolio. Okay. Also provide ongoing research on startups for investor members. Ongoing research. And of course, conduct business development and introduce officer and director candidates to startups. So the SIC basically, it comes in, educates everybody, and follows the startups, and now becomes a way for everybody, for the crowd and the public, to become involved in startups. And more importantly, it increases the probability of all the startups in those communities becoming successful over startups that are not in these communities. Now, here's the 4 social investing companies that are now operational that we've been building and developing. We have Dynasty Wealth, which specializes in finding startups that have the potential to multiply in 5 years by 100 to 1,000 times. That's obviously for high net worth investors, accredited investors. We have Join the Hunt, Trophy Investing here, which basically finds any company that has the potential to multiply by 3 to 5 times over a 5-year period or so, can become a member of Trophy Investing. We have Apps Funder, which there's going to be 5 million apps in the App Store. It's going to grow from 3 million to 5 million by the end of the decade. 3 million to 5. So many apps are growing out there. And of course, we have Sprout Ups, which is the millennial, which is for millennials, and I'll explain in a little while why that's important. That it's going to attract the millennials, and all of these are operational and have members. All 4 of these social investing communities. Now, in fact, we're going to talk about Sprout Ups. This is so important. If anybody has a startup in this room, listen listen carefully. The most important thing you want millennials in your company. Why? Because if you can get millennials to invest in your company, what are they going to do? They're going to chat it up on social media. They're going to post it on Twitter. They're going to tell their friends and family about it. If you've got a product that you need to go viral, you absolutely have to do this. I tell startups all the time, why would you want to raise $1 million from one investor at a certain valuation when you could raise $1 million from 10,000 investors at $100 a piece at the same valuation? Because now you have 10,000 advocates out there who are supporting your company. So that's why you want these millennials involved. Here's a value of $10,000 in Uber's funding rounds, $135,000 on a $10,000 investment. You know, even if you'd gotten in June 4 years later, you're talking about $80 on a $10 investment for Uber. Okay, so social investing communities, they reduce risk by providing just-in-time financings. So the biggest problem that you have as a startup is you get your first round of capital in, you really get going, and then what happens? You can't get the second round. And now you're under stress, you die on the vine. Most startups go out of business because they can't get their second round of funding. And the problem is all the venture capital industry is totally antiquated because all of them, they focus on either the first round, the second round, the third round, but none of them focus on all three rounds. So everybody's looking for the next sucker. You know, P.T. Barnum said there's a sucker born every minute. Everybody wants to invest and find the next guy who's going to come in and bail, you know, get to the next round. They get the next round of financing in for the company. And that's not, this is the way it works. Now Uber, this is a good example. Look how Uber, if you look at this, Uber, it's raised capital at $1.25 million. They raised $1.25 million, assuming that was at $10,000 a piece. That was 125 investors. And look at this. Within 6 months, they went out and raised their next $11 million from 1,100 investors. I mean, that's the hypothetical. But the point is that Uber raised money very, very quickly and just in time. If Uber hadn't been able to raise the money, if capital had not been readily available, they would never have made it. So the social investing communities allow that to happen. So here we see Dynasty Wealth. You see the arrow pointed to the seed round. That's an example. Dynasty Wealth did not recommend Uber. Dynasty Wealth was not in business when Uber came around. Neither was Trophy Investing, to make that perfectly clear. So if we're looking at the seed round, you know, Dynasty Wealth put that money in the seed round, and Trophy Investing can come into the next round, and Trophy Investing can keep coming in the different rounds and multiple rounds. Why? Because even if you came in on the Series B and you put $10,000 in it, or the Series C, you made $117 to $1.2 million on $10,000. Now, here's another thing that the SICs provide. So this is an example. Start Engine is a company that I recommended that was doing a crowdfunding of its own in November of last year. I recommended the stock in November of last year. And in June of this year, when something else happened where they emerged as a cryptocurrency infrastructure provider, I came in and I reiterated my recommendation on June the 6th, 2018. So 9 days later, the offering was completely sold out, and they announced that they were going to do another offering at $10 a share. So, and this is a private company. This is not a public company. So again, the SICs are going to provide the investors to provide a secondary market for these startups, because under the rules and regulations, startups can become liquid after a year. Now, what's going to happen? The choice trade will provide liquidity for the first time ever for the shares. So the SICs, which I just showed you there before, are through choice trade, which is the first online broker. It's a full service online broker that's been in business for years. You can have your stocks, bonds, mutual funds, all that stuff in choice trade, but now they're going to offer startups, you're going to be able to open an account at choice trade and buy into a startup opportunities right off of the choice trade platform. So you're going to be able to put all of your securities in the same basket And that's going to really, it's going to be the catalyst for startup investing to go mainstream by 2020. By the way, Choice Trade is one of the companies that I recommended that people invested in at $1.50 a share on a crowdfunding platform earlier this year. And I believe this company has potential of being a $50, $100 stock. And there'll be other opportunities that are coming to invest in Choice Trade. But the important thing is by this happening, investors much prefer a private market over a public market when investing in emerging growth companies. How many in this room have bought a stock under $10 a share? Okay, how many in this room have ever bought a stock in a company under $10 a share where the stock went up instead of down? I got one guy. That's rare. I got to shake your hand, because what happens is the lower priced shares, Wall Street manipulates those shares. So they want to shake you out. They're doing all kinds of things with it. So it gets the investor nervous. So if you can buy into a startup that's privately held and hold on to those shares, and it's like, you know what it is? It's like if you go out in the swamp out here in Broward County or Dade County and say, I want to buy 100 acres of real estate because I think a new freeway's coming in. You can just buy it and put your stake. You can buy that, and you can put a stake in the ground. I'm going to sell it at $10,000 an acre. Put your price out there. That's what you're going to be able to do with startups because of Choice Trade and the secondary market that's now emerging. Now, Miami can utilize SICs to become the next Silicon Valley. Why? Because it has 1 billion in North and South America. There's 1 billion people in North and South America who could potentially become startup investors. I'm a graduate of South Dade High School. I'm a local guy here. What I'd like everybody to do that's been here at this is to spread the word. Okay. We have this here, we have these coupons, which are trophy investing coupons. You can join trophy investing. You can invest here. So if you'd invested even at $100 in any of these 3 companies, you would have made $2 million, $1.25 million, $240,000. Trophy investing, you can join trophy investing and invest as little as $100 in companies. And there's the free member, the trophyinvesting.com, promotional code 604. This is the coupon here. We'll have them outside when you leave. If you want one, we'll have them outside outside the door. Okay. Anybody have any questions? Yes.
Hello, thank you. My name is Hans from Switzerland. I just want to ask you how many companies you have in your portfolio, startups?
Well, right now, you understand that I have a track record that is my prediction of Lehman Brothers and my prediction of the adult daycare company. All those, I have a track record that stems many years. I have about 5 companies right now in the portfolio. I've purposely been very careful to recommend more companies because I want all the 5 to multiply in value. So I'm deliberately holding back even though I see many, many companies. And we're getting ready to bring more companies in right now because we've gone to that stage. But right now we have about 5 companies in the portfolio. And they're all growing and starting to multiply. Like Start Engine is one we recommend. It's up 100%. So yeah, we've been building this since 2014. It's getting ready to really grow, and we'll be adding a lot of companies. You can also add your company. Go and register your startup in this thing, and we'll start monitoring you and tracking you. If you have a startup, you can go register your startup, put the information in there, and we will follow you. And that's what you can also do. Any more questions?
Okay, thank you very much.
I want to thank you for your time.
Thank you very much, Mr. Michael Markowski of Dynasty Wealth. We are